start. I don't want to delay this. In fact, I was going to ask a question for the next few classes on Tuesdays. If we have it at 8 o'clock, does it upset anybody's schedule? The reason I did it at 8:30 was because some students might have classes, the evening 6 o'clock class. But is there any opposition to that?
Actually, 8 o'clock would be a little challenging for me, Professor.
It will be, okay. All right, we'll stick to 8:30 then. Let me make sure I've admitted all. All right, let me, computer. Oh, so it's already recording, good. Okay, let me double check. Okay, great. So today what I'm going to do is I'm first going to start by, we got to discuss current events, and I posted some articles. So let me just go through that first. So among them, two articles. One of them was, of course, the negative interest rates. And I think we've discussed that in the past. So the article just goes on to say that how even in the US, the 1 month and 3 month treasury bills turned negative that Wednesday in March. Basically, if you had looked at a quote, you would have seen that it is negative 1.0. Now, that's a T-bill. The last time that happened was 4.5 years ago, when both T-bills turned minus 0.002. But just to give you an idea of how that works, the way it works is as follows. When you buy a T-bill from government, so what's a T-bill? A T-bill is the debt that the government asks from you, borrowing money every 30, 60 days. They're all instruments below 1 year. Okay, so the government is borrowing it all the time. 50 billion, 40 billion, etc. 30 days, 60 days, 90 days. Most common is 90 days. But the way it works is the same as with a bond. Let's say $100 is what they want to borrow from you. They basically say, well, how much will you give me right now? And usually what happens is there's a way to calculate it, but let's just say it's $99. So you give the government $99, they give you $100. And what do you make? You make $1 out of 99, which is roughly 1%, but that's 3 months. So for a full year, it's 4%. And the government continues to borrow that way. What happens in a crisis is people are jumping over each other to get the bond. So they'll, in the auction, they'll go, I'll pay $99.50, and then someone says, no, I'll pay $99.75. And then finally one person will say, hey, I'll pay $100 or $101. So that's when the negative interest rate, because they're so desperate to get bonds, and there are many pension funds, insurance companies, mutual funds that has to have certain amount of bonds in their portfolio. So when it goes to $101, that's when it turns negative at this point. Okay. So as you read the article, you'll see that has happened. Now, what is surprising is that the US now joins large swaths of Europe and Japan that already have negative debt. And one of the things I think you will see Trump complain is that he's constantly badgering with his tweets that the US should do the same as they are doing, Denmark, France, Sweden. Now, I'm sure he knows, but maybe he doesn't, but the US officially cannot offer negative yield bonds. Congress has to pass a law before a Fed can issue negative bonds. And there are some economists who are saying, why not? These banks are all parking their money at the Fed and earning 0.25%, 1% interest rate. they should instead be paying to the Fed. So a lot of banks, oops, a lot of banks right now are parking billions with the Fed. And in Europe, what they did is they said, hey, we don't want you parking money with us. So if you want to park money with us, we'll charge you rates. Instead, we want you to lend outside. And so the question comes in is, and the economists are battling over it, who is right now. So if Congress passes the law, then the Fed could basically charge the banks and say, if you want to park it with us, a very safe government, then you have to pay some interest rates. So we'll see what happens on that front down the road, okay? Again, but with the US, it's very clear, even to this day, whenever there's a crisis, so far, whether it's in Europe or whether it's in Asia, money suddenly flows into the US. And because of that, the price of the bonds go up. And now you know that means the yield comes down. So people are willing to pay more and more for government bonds, which means the yield comes down, which is very good for US consumers because the rates are kept very low that way. Moving to the next article, this one talks about the high beta stocks that we discussed in the last class. So what this article says, and recently, high beta stocks have, as usual, what did we say during the lecture that I have? We said that a high beta stock is, let's say the Dow, let's say here's the return. We said when the Dow goes 10%, let's say the high beta stock goes 20%. When the Dow goes 20, this goes 40. Dow goes 60, this goes 120. I'm sorry, yeah, etc. So twice as volatile. So that's a beta stock of 2, right? And the same thing when it goes down under. So if you looked at the article, you'll see that's exactly what has happened here. The Invesco S&P High Beta Exchange Traded Fund, I'll get to that later. These days, you can buy individual stocks or you can buy a portfolio of stocks through what are called exchange traded funds. So look what happened to them. When the S&P came down 18%, they came down nearly twice, 35%. Okay, but of course, high beta stocks will do well when the volatility comes down. So when the S&P recently, but now it's today, last 2 days, it's down, went up 7.9, of course, a high beta stock went up by 12. So what Barron's did is they took us 500 stocks all over 1.5 beta. And then they said, let's remove all the ones with high debt. So out of the 500, they came out with these 9 companies and said, look, this might be a good time because if the market goes up, your high beta stocks will go up twice as much or 1.5 times as much. However, they caution, this is not a recommendation, this is just a screen, because they give the example of one company called Ulta, which is a beauty company. So much as it's a high beta stock, they're asking you to be careful because because of the coronavirus, their same store sales dropped by 80%. Well, it's happened before a long time, but that should be something to keep in mind. And same thing with NVIDIA, which is a computer company. All of their technology is used in cars. So if the car sales comes down, you got to be careful about that, okay? Now, what I would like to do now for the next week is I would like to follow another news that's going on in the papers as we speak, is what is happening to Argentina. Argentina owes a lot of US dollar debt to a lot of US banks. What Argentina did recently is they basically told the banks, and investors, and that includes investors like BlackRock, saying, hey, we can't pay the interest anymore, so you have to restructure the debt. Okay, so so it's going to be an interesting debate. It's about 40 billion in debt. They're asking for a 3-year moratorium, and then they want to reduce the interest rates to 2.33%. So this was actually announced a few weeks ago, and then they gave some time. And today, the bondholders, the trustees, the ones that you learned that manage, the negative and positive covenants, right? Now, they also manage all the terms of the bond. So it includes a lot of these asset management companies. They have formed a committee called the Argentina Creditor Committee, and they have refused the offer. So basically, the government had given the bondholders 20 days to review the offer. They have refused. Argentina faces 500 million in debt for tomorrow. If these payments are missed, technically that means the country is in default. And if it's in default, then the trustees, the bondholders, can then take any assets of Argentina. So if a ship comes from Argentina, they can confiscate the ship. Now, usually that doesn't happen. Argentina has been in default twice in the last 15 years. So we'll just keep in touch and see what will happen. It's always a big story with bondholders. Should we let it default and go through all the hassles of collecting the money? Might be more painful than agreeing and saying, listen, let's just all agree, we'll give them a different interest rate, and then it's just a haggling on, okay, we'll let you not pay interest for 3 years, but after that we need so and so and so much. So another example of a bond, but this time in a big number, that might get into trouble. So when you get a chance, do read up on it. Oh, let me see, there's a chat box. Could you comment briefly on the price of oil? Yeah, that's another shocker in terms of the demand. Now, there are people who have argued that ever since the US became independent on oil, at some point or the other, and as more and more countries shift to other forms of energy, that this was going to come down at some point or the other, not to zero. The zero case is a case, listen, this is the first time ever where we have the whole global economy shut down. This is a case that has never happened before. Here's US, here's Russia, here's Europe, here's South America. I mean, everybody's economy is coming down. So this has never happened in history, I guess, except perhaps during World War. But even during World War, there's a huge amount of manufacturing going on. Here's a lack of demand completely. So to hit below negative, basically, and that there's a reason for that, because oil storage is expensive. So people would rather give away the oil than to put it in storage themselves. So they're willing to take a negative money, which is they'll pay you to take the oil off their hands. But again, it all depends on the recovery. At this point, Europe has started to open up. There's now more and more evidence that the mortality rate is much lower than it has been suspected. And I've always been against the national lockdown anyway. I think the lockdown should have been targeted lockdown before you go to a national lockdown. So, but if the economy revives at this point, then the oil prices will stabilize, but will remain low. And it will remain low for some time, I guess, because there is a glut of oil. So unless the economies revive back to the rate, China lost 6.8% GDP last quarter. And now they've started to come back, but it all depends on the comeback. So, in the case of oil, the reason it is negative is because there is storage cost. So if you've already pumped the oil out, what are you going to do with it? You got to store it somewhere, and storage costs are expensive. If you can get rid of it for $99, sorry, if you can pay someone $1 to take it off your hands, you may want to do that at this point. So markets are going to be very volatile for the next month. Now let's see. Europe seems to be leading the way. Denmark, Netherlands has loosened up a little bit more today. Some states in the U.S. have started to open up. So if everything opens up by May 15th, there is a chance that the recession will be mild as opposed to what happened in 2008. Okay, I don't want to spend more than 15 minutes. More questions next time. Now, today, what I want to do, though, first is there's quite a few people who are still asking questions on the quiz. And so let me answer that part. I don't want to close the whole thing. I do want to go over some of the problems that we had, and then we can continue on to chapter 9. So first, and especially on the verbal question, because some of you got 2 points taken off, etc. I want to explain that. So edit the test. Let me go to question 3. So something like this. The question basically said, as interest rates increase, the present value of a sum increases at an increasing rate. And some of you got, as interest rates increase, the present value of a sum decreases at a decreasing rate, should have been a decreasing rate. So the question is this: how do you answer this question? Well, you have to be very clear. This is an open book test. You have all that information in there, and we have discussed it in class. So once if some of you define the relationship, that's fine. But the key thing to note is you have to clearly explain that if interest rates is 5%, if interest rate is 10%, if interest rate is 5%, what happens? The future value of 100 will become, let's say, 105. The other one, so let's say 105, 110, 115. But as they continue to grow, because this is earning more interest, it will compound itself, and therefore it increases at an increasing rate. And if you want to even show the graph that we have in both in the textbook and my lecture notes, it's good. So you have to explain it as if you're explaining it to Greta. Why is it increasing at an increasing rate? And in the same case with the present value, why is it decreasing? The easiest is to do exactly what I did in class to show you what happens when it goes from 5 to 10%, 10 to 15%, etc., like that. The percentage increases at an increasing rate. Then one of the next question was question 4. So let's take one of them. You deposit 3 years in a bank for the next 5 years, with the first payment beginning at the end of, oh no, this is not this, sorry, it should be number 5. Wait, was it this one? This is one interest rate. There was one with double interest rate. Let me just see. Or maybe it was 2. Yeah, this one here. What is the present value of 10,000 that you expect to receive in 10 years if the interest rate is 5% from year 0 to 5 and 7% from years 5 to 10? So you are supposed to receive 10,000 in 10 years. The thing to remember, though, is that this portion here is 7%. This portion is 5%. So the only way to do this is to first take this at 7% here, get this number, and then get this here at 5%. And we have done a problem like that. I don't know why some of you had trouble with that at this point. Now, the other part, maybe this is where some of you, this question was different. It said you deposit $1,500 in a bank today. What is the future value of deposit if the interest rate is 5%? So here you just go the other way around. You have 1,500 now. And then you go over 5% here and then 7% here, whatever number you get here. And then you get this point over there. Company paid a dividend. Oh yeah, no, I'm getting to that question, Bhavita. That's on the list I have. All right, now I'm just going to go over some verbal questions. Let me see that one of them was it 5, 6, 6? No, 5. Oh, 6. Right. So let's just take a question like this. What is the relationship? What's the relationship between the present value of a sum and an interest rate? Be brief and quiet. So again, you need to, sorry, go ahead. Whoever wants to ask a question. So here the question is, what's the relative present value of a sum and interest rate? So basically you have a sum here and you want to find the present value. Same thing as you did in this case. I think some of you did have repeats. You have to say the present value decreases, but you have to also explain what it means. It means that the reason we can give a present value is because of opportunity cost. You know, how can you give a value today for something in the future? You say, well, if I have something now and I could invest, so if I had 0 interest rates, I won't. But if I could invest, then I would get this 1,000. So based on that, I'm able to give it a value of present value. And the other thing to note is that the present value decreases at a decreasing rate. And you could show that example just like I did with the book. So in other words, the next time you see a verbal, 2 things. You go to the text and see that, or you go to the lecture notes, the PowerPoints, and I'm sure I've explained it in the same way as I've done, but you have to explain it as if you're explaining it to grandmother. So it's clear and concise. I think all of you got right on that. Yeah, longer term bonds are riskier than shorter term bonds. That was clear in one of the discussions, right? We showed you that if you took a 5-year bond, the volatility was this, and a 30-year bond, the volatility is this. And then you need to clearly show that. You could say if I have a 5-year bond and the interest rate is 5% or the interest rate is 20%. Just like I did it in my lecture notes, 30 years, 5% and 20%, see the change in the price of the bonds. The longer term bonds are way volatile than the shorter term bonds and hence are riskier than that. Now, if you want to add on other things like you locked your money in, etc., that's fine. But the main reason for defining risk, which is volatility, it's higher for longer term bonds. Protective covenants. I wanted to see both. I wanted to make sure that you read the notes where they clearly say there's negative protective covenants and positive protective covenants. And if you defined that and then you explained it, gave some examples, then you got it right. Yeah, this is one more, the stock. Let's take an example. I'll do the first one, whatever this one is. So in this question, it says, copy. Let me get the solution too. Okay, so let's take this. A company paid a dividend of 2 and expects to increase dividend by 12%. So if it's paid a dividend, that's gone. So it paid a dividend of $3.50, but that's gone. Now it'll pay 12% more every year. So let's take my calculator, which is, so what will be the first year's dividend be? $3.50 times 1.12. So 3.5 times 1.12, 0.5 times 1.12 is 392. Then the dividend after that would be 1.12, would be 4.39. Then it'll be 1.12 again. Is 4.92. And thereafter, it's actually 917, it will grow off at 5%. So times 1.05 is 5.16 in year 4. So after that, because it's going to grow forever, we can use the formula. But we have no choice but to take these three separately at this point. Then we will take the 4, 5, 6, 7, 8, etc. by using the formula, which is P3 will equal to D4 R minus G. And D4 is 5.16, R is 14 minus G is 5%. So 516 divided by 0.09 is 5733. But remember where you are. You are in P3, so you're right here. 5733. So you'll only take this back 3 years at this point. Because 5733 represents the present value of 4, 5, 6, 7, 8, 9, 10, all the way to infinity. And then when you get them all 4, you should be able to get the total. So if I took the present value of this, 3.92, what is the rate of return? 14, that's what I need. So if I divide it by 114, I should get 3.84, sorry, 43, 3.44 right here. Then this one would be 3.38, 3.32, and then the present value of 5733 is 38. I add them up, and lo and presto, the answer is 4855. So I think the mistake a couple did is that you took it for 4 years instead of 5 years, this particular number. And I expressed it in class as well as in my video that you have to, it comes back and you only take it for 3 years at that point. Questions? Okay, moving on. So, cancel. The other one was 11, 12. What was 12? In the cumulative voting question. Many of you tried, but again, you have the book and you have my notes. It's very clear that it is to protect minority shareholders by giving them cumulative votes, but you have to be a little bit more precise. Even in my lecture notes, I have it. How does that work? Well, the formula is 1/9 percentage plus one vote. And then you can give an example. So if there was 80 and 20, let's say there's 104 directors, well, as long as this minority had 21, and this one had 79, because if you do 1/4%, that's 25, 1/4, sorry, that's 0.25%, then it's 25 votes. I'm sorry, 1 divided by 4 is 20. So that's 20 votes plus 1. So as long as you had 21 votes, you could elect one director as a rule, and that was the rule. So, so again, be specific, and then believe me, there's always, I've given that answer either in my notes, and you have to explain. By the way, I noticed a couple of you got some answers from I don't know where. You probably just Googled Investopedia. But when I see that, then you're not explaining it to me what it is. It sounds like you just read it from there, which tells me that you did not read from the textbook or from the lecture notes. And I know some of you are in a hurry, but again, you have to be clear. Now, in this question here too, within the historical context, it tells me whether you read the note. We clearly showed it to you what happened from a historical perspective, what happens. We had that example where we showed T-bills, we showed T-bonds, we showed, and then there was corporate bonds too, but let me just go to stocks, and then we had small stocks. So you have to say within the historical context of 1925 to 26, this is what you notice. This is a huge difference. And then this was even way higher. But so small stock, but also the evidence is very clear. The volatility on this is much higher. This is lower, and this is barely volatile at all. So if you wrote something else on your own, etc., but didn't mention the historical returns, then I know you haven't read, or you've forgotten the chapter, you didn't have a chance to read it. I gave 1 or 2 points here, depending on how well you explained it. You had to be a little bit more clear exactly. And again, this was only from the point of the issuer. I didn't want anything from the point of view from the investor, but I didn't take points off, but you had to make clear from the issuer's perspective, what were the costs and the benefits of issuing perpetual bonds. Oh, by the way, I thought I read an article. Let me see just quickly. Again, I don't want to spend too much time, but thought I read. He's asking Europe. Yeah, here it is, The Guardian. George Soros is asking Europe to issue 1 trillion. Oh, that's funny. This is from her, but actually, from where I read earlier, that the idea came from George Soros. So what they're saying is borrow $1 trillion perpetuals at, the rates are so low now, it will actually cost only $5 billion a year, every year forever, to find. And then 1 trillion can go a long way towards the infrastructure project. Maybe the US should think about doing that too at this point because of the interest rates. I'm sure the market would demand a little more, but even with that, it's not going to be that bad. Okay. Now it's back to election notes. So I hope everybody read chapter 9. And now do remember that our next class is on Saturday. We have one, I think it's the only Saturday class we have at 9 o'clock when we'll do chapter 10. And when we do chapter 10, then I will be giving you your case. I'll put you in the teams, but you have a long time. You have till, that's what I was trying to go to. Let me just go to so just a quick reminder for our next classes. So the next class is Saturday, April 12 at 9:30 a.m. Go over chapter 10, then I'll give you your case. And then 28th and May 7th. 28th, I'm going to go over 14, but barely cover 16. I'm just going to explain what 16 and 17 is because they are theoretical chapters. And then I make it open for you on May 8th. But the case is due May 15th, so you have a lot of time to have at least 20 days to work with your group to do the case, okay? Any questions? All right, so without further ado, let's go to it. So chapter 9 actually talks about the three methodologies: payback, net present value, and IRR. In chapter 10, we're going to apply it. And that's why once you know how it's applied, you can start on the case at that point. So, okay, everybody, let's have a honest one. How many of you did not read the chapter? Everybody read the chapter? Okay, then that makes it easier. So I'll go back to this. So the net present, the first method is payback, and the payback method is really very simple. As I showed you, why do I have all this open? As I showed you, let's take a project as follows. I'm going to invest, go to the top. I'm going to invest $4,000, I don't know, opening up a bakery. And what I anticipate getting back is, let's say, $2,500 in the first year, $2,000 in the second year, and $1,500 in the third year. The payback is a very simple, it was what was used for millions, I mean, not millions, thousands of years by investors. They just want to know how quickly their money will come back. So let's take a quick look here. In the first year, you'll get 2,500 back. You spent 4,000, sorry, this is negative. Negative. So you plop in 4,000 or 4 million to open up a store. You, after all your analysis, you say, I'll get net 2,500, 2,000, and 1,500 in 3 years. So if you get 2,500, then all you owe is 1,500. That means you will recover your money even before the end of the 2 years. So, well, someone said, grandmother said, well, exactly when would you get it in the second year? So you say, okay, well, I can assume this. I need 1,500. Let me assume that 2,000 comes in evenly down the road. If that's the case, then I should get it exactly 0.75. So I can say that this money I'll get in 1.75 years at this point, right there. So, no, that's the payback right here, 1.75 years. What about the other project? Let's take a look at the other project. Same amount of investment, but you're going to get 1,500, 500, and 4,500. So I'm going to get back the money. First year, only 1,500. That leaves me with 2,500 left. Second year, unfortunately, I'm only going to get 500. So the bulk of the money is going to come in the third year, which is the 2-year plus, after the end of the 2 years. Exactly how much? Well, you say, okay, it's 2 years. I'll collect 2,000. That means I have 2,000 left. Divided by 4,500 gives me exactly 2.44 years. So the rule is simple. In payback, you choose the project which gives you the money back the fastest. So in this case, you are definitely better off choosing the first project, if that's your criteria, payback criteria. But you should then go over and see what are some of the weaknesses of the payback. One of them is, of course, it only looks at the payback period.
You mind if I ask a question? I'm sorry.
Go ahead.
If we were going to use the formula
Mm-hmm.
instead of the method you just did, I was trying to figure out the formula. I didn't understand what part of the formula, the recovered CFs. What is, I know, I understand the years to over recovery, the initial investment. What is the recovered cash flows?
Right. So that's why I personally think you don't even need to use the formula, just use basic knowledge. But just to be clear, we said years to over recovery. So in this project, in the second project, the 1,500 and 500 is not going to cover it at all. So the over recovery period is the third year here, right? Because we will get our money, but we'll actually get more than what we need at that point. So that's 3 years then in that case. So if I were to write this down, I'd say 3 minus 1. So that means minimum is 2 years plus. Now, let's look at the initial investment was 4,000. How much did we recover so far in the 2 years? Was 2,000. So that leaves me with 2,000 more to cover. And how much am I going to get in the third year? 4,500. So that's how it reads. So the formula makes it look so complicated, but really, it's just 2 years. Okay, I know in 2 years I'm not going to recover. And then I'll recover it in the third year, but let me see exactly when in the third year.
Okay.
When before.
Thank you.
No problem. So, and then the other way to do it, of course, is to do the discounted payback method. And here we are saying, listen, one of the criticisms is that you don't consider the time value of money. So you say, all right, I can solve that. Now let's see how you'll explain it to grandmother. Basically, what you're telling grandmother is, grandmother, I'm going to put in $4 grand now. Now I'm getting 2,500 next year, but I want to take it in terms of the present value. What is it worth today? So in today's term, I find the present value, it's 2,272. This 2,000 is 16589, 2.89, and this is 11269. So now calculate the payback so that you've taken care of the time value of money. So let's see, first year 2,272, and you don't cover it. Add the second year, you're short by $74. So the minimum you'll have is 2 years. That's your over recovery minus 1. And then you only needed $74 to recover. And in present value terms, you're getting only 1,126.97. So that's why the discounted payback says you will recover your money in 2.066 years. And when you do the same thing for this one, it's 2.658 years. And hence you will still stick with project A because I'll recover the money earlier. So that was the payback. Very simple to compute, and it's still used in corporate America because as a secondary tool. So after you do all the net value calculations, you also take a quick look and say, well, which project gives it to me faster? And if it is, it can become a consideration at that point. But the most important method that all companies use, and which is the superior method, is of course the net present value method. Now in Excel, it's very easy to compute, but what does it mean from a point of view of understanding what these numbers mean? So I go with the same project, but then what I do is I take the present value of this, the present value of this, just like I did with the discounted, and then I subtract it from 4,000. That's my net present value, and this project's net present value is 1052.59. I do the same here. I find the present value of this, the present value of this, present value of this, and subtract it. And I get 1157.78. And the rule is, if they're mutually exclusive, which means you have to choose one or the other, choose the one with the highest net present value. Right there. Choose the one with the highest net present value. But what is really important is that you understand and say, what does this 1052 mean? You know, is it a profit number? Is it not? And I'm going to repeat that explanation that I do here by telling you that this is what it means. It actually represents a profit number, except in present value terms. So let's go down and let me do that example. And once you get this idea fixed, I think you've understood net present value pretty well. So in the first project, we had to dish out 4,000, and then we get 2,500. Clear how much we get? Yeah, 2,000. In year one, we get 2,500. Sorry, to 2,000 and 1,500. So the way to explain this is very simple. Let's say you had to borrow money to run this project. So you go to grandmother. I think in my video I talk about grandmother. You go to grandmother and say, all right, I need the money. And she says, fine, I'll give you, but you'll have to pay me 10%. So you get the money at 10% or from the bank. And along comes the first year. And you owe the bank how much now? So you owe the bank 4,400 times 10% interest means you owe the bank 4,400. So let's say you decide and said, look, all the profits I make, I'm just going to pay off as quickly as I can to grandmother, because grandmother can be nagging otherwise at times. So outcomes, that means at the end of the first year, you owe grandmother only 1,900. Now, along comes year two times 1.10. means you add another 190. So you still owe grandmother $2,090. You pay away the full $2,000 profit that you get, so you're only left with 90. And then the following year, at 10%, you only owe grandmother 99, which means you will have $1,401 left in your pocket at the end of the third year. Now, what does that? If you took the present value of that, now at 10%, it'll be exactly be 1052.50. So what this number represents is saying, look, at the end of the third year, after I pay off, or my earnings of 10%, it could be own money, the amount in this case is 1,401. And in the case of the second project, 1157.78 is present value, 3 is N, 10 is I, 0 is payment. Future value is, in this case, the money I'll have here is 1541. Because the present value of that is 1157. So you're explaining to grandmother, I'm choosing project B because at the end of the third year, after 10% is paid off, if I borrowed it, even if it's my own money, after I calculate the 10% that I owe myself, I will be left with more money. Hence, the rule should be choose the project with the highest net present value, because it tells you exactly that you have this much more money beyond the 10% that you'll have at the end of the project. So yeah,
can I ask a question? I'm sorry.
Sure.
I think it's probably a typo on the slide, because I was looking when I was studying. It says project A should be chosen. Actually, project B should be chosen because it has higher NPV.
Where is that? Let me see.
The slide that you just had, slide number
Right.
12.
This one, 12?
Yeah.
Oh, yes, correct. Oh my gosh. B. What is that doing there? Yeah, so I'll up, wait, let me write this down. Slide 12. But even in, what about my video? Did anybody watch the video?
Yeah, it was wrong. It was the same thing in the video. It said A.
A should be chosen.
Yeah.
No,
I
no,
mean, you explain like you did now that higher value is preferable,
right,
but then the slide is like contradicts that. So it's like, I mean,
right. Okay, I'll also check the video.
yeah, I mean, in the homework you did stick with the higher value. I
Right.
mean, I did homework, so it is correct.
Okay, this must be an old thing because I remember this being somebody raising this like 10 years ago, because I'm using the same example. Just for your information, this particular example is being used by like about 10 different professors who got their PhDs in Indiana, and it was developed by a colleague, DJ Masson, who still teaches at IU. And we were all graduate students when he did this. And so I think it's been used 30 years by now because he made it so simplified. And so we always use this example. So along the lines, just, read it in power. Those days it was paper pencil. But anyway, thanks for pointing that out. Yeah, correct. Now, so that should be clear what NPV is. And now we go to IRR. And if I continued the story, let me see if I have the graph here. Oh, I don't have the graph here. So let me continue the story. So just as you were about to get this money from grandmother says, no, I've lent you enough money. I'm going to charge you 20%. So you go, shoot, do I still take the money from her and or do I not? So let's see what happens when you do with 20%. Do you come out okay or not? So let's see, at 4,000, if you have to pay her 120, so that means at the end of the first year, I owe her a whopping $4,800. I pay her the full $2,500, and I'm still left with negative $2,300. Along comes the second year times 1.20, and I still owe her negative 2,760. I get the 2,000 and I get $760 still owed to her. So I multiply that by 1.20 again. So minus 2,000 and times 1.20. and I have 900, I still owe her 912, but hey, I'm getting 1,500, so I will end up with still be 588. If I were to take the present value of that, so I'm going to use my cash flow buttons now. Second, clear work, 4,000, change sign, enter 1, 2,500, enter 1, 2,000, enter 1, 1,500, enter 1, net present value, 20%, enter down arrow key, compute, and my net present value is $340. Let's say in this case, this is the only project you have. Don't compare it to the other one. Question, do I still take this project? You say, what the hell? I'll still end up with $588 at the end. I will go ahead and still borrow the 20% from grandmother. But then again, grandmother, she's trying to dissuade you as much as you can. She says, oh, did I say 20%? I'm sorry, I meant 30%. So then you go, oops. Now let me calculate the number. So I won't go through this example, but I'll just recalculate by net present value at 30%, enter down arrow key, compute, in a negative 210. That means you will have a negative number over here at that point. So obviously at 30%, you're not going to go for it, right? Between 20 and 30, there'll be a number where NPV is equal to 0. So that's the maximum rate that you can borrow from grandmother and still come out with just barely 0 at the end of the third year. That number is called the IRR. And all you have to do is to just press the IRR button, compute, and you'll get 25.88%. So if grandmother was to lend you beyond 25.88%, your net present value will be less than 0. So IRR is kind of like the max rate. It tells you what's the maximum, that you can borrow at, where you'll still take the project, but you won't make any profits at the end of the third year, but you'll just barely cover your interest payments at that point. And it goes the same way. It can be equity payments too. If grandmother gives it to you as equity and your shareholders are demanding 25.88, you can barely make it. But yes, you can deliver a 25.88% return to your shareholders. So the IRR method is the same as the net present value, but basically it gives you like the max rate, right? So, so at 25%, the net present value would be for project A. Now, interestingly, if you did the IRR for project B, the NPV will turn out to be lower than A. What does that mean? That means if I were to use the IRR method, I would actually choose project A. But when I use the NPV method, I chose project B. So what happens then? So the reason that happens, it happens very rarely. But when it happens, what we say is that you are better off choosing the net present value method, because this is what exactly happens in the NPV and IRR between two projects. You have what is called an area of conflict, and that happens right here. So just take a look at this graph. This is important. So what you notice is that in the project A, the first one. What is the net present value of my project when the interest rate is 0? So let me write this down again. Here's my project. This is year 0, 1, 2, 3. What's the present value of my project if the interest rate is 0? What's the present value in period 0? If the interest rate is 0, it should be? Nobody's answering?
Be the same.
It'll be the same, 2,500, correct? Right, and I know it wasn't Zoran who answered, but the present value of 2,000 will be 2,000. The present value of 1,500 will be 1,500. So you basically just add up the numbers, 4,000, 6,000 minus, so the net present value is 2,000. So in this graph, this is on this axis, I have NPV, and on this axis, I have the K, or the interest rate. So when the interest rate is 0, the net present value of project A is 2,000, and the net present value of project B is 2,500. Okay, so I got these 2 points. Here, this is the interest rate when net present value is 0. That's my IRR. So it's 22.5 for project B and 25.88 for project A. And as you can see, they've crossed over. And this thing is called the crossover rate. So to the right of the crossover rate, there is no conflict between net present value and IRR. IRR says choose project A, and if you go past this interest rate, notice the blue, and if you calculate the net present value at 16, at 18, at 20, at 22, 24, A will always turn out to be higher than B. But before that, the net present value will say take B, and IRR will always say take A. So we have a conflict. Now, before we do the solution, you know, always choose NPV. One question that might be asked is, how do you calculate this crossover rate? Actually, it turns out to be very simple how to calculate this crossover rate. So let me show that example to you. All you have to do is, so here you have these 2 projects. One is negative 4,000, 2,500, 2,000, and 1,500. The other project was negative 4,000, 500, 4,500. Even after all these years, I just want to, or rather keep forgetting. Project is 1,500, is 1,500. So to find the crossover rate, just take the difference between the 2. Okay, remember, these are both negative. So to take the difference, you have to change the sign. Make this minus, minus, minus. So minus 4,000 plus 4,000 is 0. 2,500 minus 500 is 1,000. 2,000 minus 500 is 1,500. 1,500 minus 45,000 is negative 3,000. Once you get this number, find the IRR. So I want my class now to do it in front of me find the IRR of these 4 payments. So the first thing you do is cash flow, second, and clear work. Then when CFO comes, your first number is 0, so you can just put 0 or down arrow key. CO1 is 1,000. CO2 is 1,500. CO3 is negative 3,000. Then all you do is to press IRR compute. So tell me what numbers you get. I'll wait for a few minutes.
So what is the interest rate?
There is no interest rate. That's what you're trying to find out. At what interest rate is this present value equal to 0? So once you put in this number next to NPV's IRR, just press IRR compute. Okay, Chrissy has got it. John, Alifia, Erika. Exactly, 13.75. So if you go to the diagram, there you see it. Oh, where's my diagram? Right there. Let me erase all this crap here. So exactly at 13.75 is the crossover rate. Now, I have provided an explanation of what this 13.75 means. It looks a little complicated, but it's not. All I want you to remember is the reason. So if there is a conflict between NPV and IRR, we choose NPV. Why? Because one, the IRR method assumes a very unrealistic reinvestment rate assumption. So what it means is the money that we get in between is invested at the same high rate of IRR. And that is not realistic. And to show that, I do this example here. I said, listen, let's say we took this project on, right? We have both of these projects, but let's see what happens. I put in the 4,000, geez, these negatives are missing, the 4,000, and then I get the 2,500, 2,000, and 1,500. But let's say when I get the money, and let's say it's my own project, I can only invest it at 5% because the bank is only giving me 5%. So take a look at what happens. At 5%, it'll say take project B at this point. Say take project B. At 10%, so all the in-between monies, let's say take project B. So then I go to 15%, that's where it changes. It changes and says you choose project A. So at 13.75, both of them are exactly the same. So the argument is that, hey, if it is below this rate here, this is a more realistic assumption. Hence, if you use the net present value, it will say choose project B. So, and that's the reason we say net present value is better, because it assumes the reinvestment rate is more realistic, because it has to go beyond 13.75% and above for you to start saying accept project A. So for that reason, well, that's one of the reasons, is this unrealistic reinvestment rate assumption. That's a weakness of IRR. The second is this multiple rates of return. So let's take a project that has the following numbers. Minus 1,000, I put in the money. I get 3,200 the first year and negative 2,400 the year later. Let's try to find the IRR of this project. So let me plug in the numbers and you do the same thing too. Clear work. 1,000 negative is CFO. 3,200 is my CO1, one time. 2,400 change sign, enter, down arrow key is my second one. IRR compute. And what do people get? Okay, well, Chrissy got 20, I got 20. Some of you should get errors. John, 20. Okay, let's see what the others do. So nobody else is trying, okay? Well, what did we do? We took this present value, and at 20%, your net present value is equal to 0. So let's do it. 3,200, 20%. I'll just divide it by 1.20, and I get 2,666.67. Then I take the present value of the other one. At 20%, that is 166. So add them up, NPV is equal to 0. So you say, okay, IRR 20 is correct. But it turns out that if I use 100%, I get the same answer. So if my IRR, if I use an interest rate of 100% instead of 20, I get the same answer, net present value is equal to 0. And the reason is simple. Every time there is a change in sign, notice minus, plus, that's okay, but now there's a minus, then you'll have 2 IRRs. If there's 3 changes in sign, let's say you have negative 2,400, negative 2,400, then plus, 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 you'll have 3 IRRs. So the problem is, and the reason is because the graph looks like this. You get a negative net present value of 0 over here, and a Z present value at over here, 100%. So that's the weakness of the second. Net present value can give you multiple IRRs. So if there is a conflict, please choose NPV because it is more. So your next question is going to be, well, if you're doing that, why are you even teaching IRR? The reason is in the industry, it is so much easier to use IRR because 95% of the time there is no conflict. So it's so much easier to say, oh, I have 3 projects, project A, project B, I'm trying to choose one of them. I got 3 proposals. It's so much easier to say this is giving 19%, this is giving 20%, and this is giving 24%. Instead of saying, well, at NPV at 10%, it's 3,255, 4,016, and 7,111. But at NPV at 15, the difference is not high. So industry prefers to use, just this simple instead of these dollar numbers at that point. So since the conflict occurs rarely, industry uses IRR, but backed up, of course, at the back room or by the analysts, the CFOs, with NPV at that point, okay? But in principle, they are the same methodology. Quick note, in 1959, only 19% used NPV of IRR, with 34% used payback. By 1950, MBA schools started teaching net present value and IRR. By 1981, over 81% of large companies use NPV and IRR. And finally, in 99, one study showed all of them use NPV, and 57 even use the payback method as a criteria. Okay, so that does that for the class, but I did have a problem that I would like to quickly solve in the next 15 minutes. I took it from an old exam. So here it is. The following cash flows are given for project A and B. So the first question, what is the net present value at 10% and internal rate of return for both projects? Which projects would you recommend and why? So let's see if you can all do this in 5 minutes. Easy to find the NPV. Put in negative 400 as cash flow 0, 55, 55, 55, then 225, 225, calculate net present value and the IRR at the same time. So I'm going to do that. So you guys also, I'm going to calculate it. NPV of A, NPV of B, IRR of A, and IRR of B. All right, let's start with the first one, cash flow. Second, clear work. 400,000 change sign, enter down arrow key. 55,000, enter down arrow key 3 times. 225,000, enter down arrow key 2, enter down arrow key. NPV 10%, enter down arrow key, compute. I'm just going to save the number. I'll wait for my class to tell me. Then I do the IRR. I press IRR and compute, and I have that number saved. So let me get the first numbers, and you don't have to do the second. Okay, 30.162, correct. How many else? And 12.21, that's correct. Chrissy's also got it. John, what about the IRR? Just press IRR compute. That's correct. Who else? Brian, you have to give it a shot. No, Erica will answer soon. Sandra, sorry. Plug in the numbers. Oh, on work call. Okay, no problem. Sandra, okay, good. 31.162. Now press IRR and compute, and you should get the same numbers. So what do we get? We get 30.162 and 12.21. Now let's quickly do the other one. That's simple too. Clear word second. So 600,000, change sign, enter down arrow key. 300,000, enter down arrow key twice. 50,000, enter down arrow key 3 times. NPV 10, enter down arrow key, compute. I'll wait for somebody to give me the answer. Store 4, IRR compute. Store 5. I also have the answers here. Let me just double check. 12, that's correct. Recall 4, that's correct. So what do you get for IRRB? Oops, sorry, this should be here. Pen. Thought I saw somebody answer. No, not yet. 1.27, that's really low. 12.28 IRR is correct, but what about, oh, I see, you already answered that, correct. Exactly right. 23.423 and 12.28. So obviously, if we use the NPV method, which one would we choose? We would say choose project A. If we were to choose the IRR method, we'd say choose, because they got a higher interest rate of return. So I choose project A. So since there's a conflict, I wonder what the crossover rate is. So the next question obviously is going to say, what is the crossover rate? Explain the significance. So to do that, it's very simple. We take the difference between the two, A minus B. So we can start here. Minus 400 minus 600 is 200,000. Sorry, that's this one here. 55 minus 300,000. Wait, I'll just mute everybody. 55,000 minus 300 would be negative 245,000. $55 minus 300, negative 245,000. Now 55,000 minus 50 is plus 5,000. 225,000 minus 50,000 is 175,000 and 175,000. So wait a minute, let me just double check that there's no two change in signs here. 400,000 minus 600 plus, it's plus 200,000. That's a negative, that's a negative. A positive, negative, and a positive. That should be okay. Let me just see, I forgot this particular question, but let's do it and see what we get. So we put in these cash flows and get the IRR at this point. So minus 450, 55, then it's positive, positive, positive. This will be good. Second, clear work, 200,000, enter down arrow key. CO1 is 245,000, change sign, enter. Boy, some people have already solved it. 12%, 12.03. Okay, let me quickly do it too. Twice, enter down arrow key. 5,000, enter down arrow key. And then 175,000, enter down arrow key 2 times. IRR compute. 12.003%. Very good. 12. Yeah, and it's and the significance is to the right of 12%, there'll be no conflict, but to the left there will be conflict at this point. 12.003%. Okay, just to be clear, when I mentioned about the change in sign, you start. I wonder if there's another solution to it. I'll check back later on that, because technically there's two change signs. So there should be another IRR number. But here's the next part of the question that you might get in your test. So here it says the following. So what cash flow in year 5 of project A would equalize its net present value to NPV of project B, assuming 10% return? So let me just refresh your memory. So net present value of project A was, recall 7, was 30,162.18. NPV of project B, recall 4, is 23,423.64. So let's read the question carefully. What cash flow in year 5 of project A, that is, we're talking about this, would equalize its net present value? You see that net present value was 30,162. Let me write it down here. 30,162.18, 23,423.64. So that it would equalize its net present to the net present value of project B. So obviously, should this number be higher or lower? Because we want the net present value of project, its NPV, to equal to that of 23. In other words, we want this to come down to 23,423.64. So will it be a higher number or a lower number? All right, let me rephrase the, let's see who answered it. Lower, correct. Put it to low. Yeah, obviously, because right now at 220, this is higher. So the question is, how much lower should it be? So actually, let's take the difference. 30,000 minus 23, blah, 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 equals 673,855. Okay, so oh wait, let me look at these numbers here. So recall 7 minus recall 4 is 673,855. It is. So the difference is that it is 673,855, right? 55. But the unfortunate thing is, this is the present value. So this value is not here. Oops. This value is not here, but this value is in present value terms. So it's 673,855.55 over here, because this is the present value, this is in period 0. So obviously, what should we do? We should take this forward to year 5. So negative 673,855 is present value, 5 is the end, 10 is the interest per year, 0 is the payment, compute future value, change sign present value, 10 is I, 5 is N, 0 is payment, compute future value. I get 10,852.50. Let me just double check down here. 10,000, yeah. Oh, people have already answered. Okay, 10,852. So what should happen in year 5? In year 5, if the number was 225 minus 10,852.50, store 1, 225,000 minus recall 1, if this was 214, 147.50, And my net present value will turn out to be exactly 23,423 at this point. Double check. 214,147. 214,147. Questions? Okay. I will post this video and we'll meet on Saturday at 9:30 a.m. and go over chapter 10. In the meantime, have a good weekday. Oh, and have a good next 2 days. Oh no, today's Tuesday, Wednesday, Thursday, Friday. Any questions? I think last time when I was just about to shut it off, I heard someone say a question, but never got to it.
Yeah, I have a question. I mean, it's kind of silly because you said so many times about that conflict to the right and no. I mean, conflict if you go to the left of the crossover and no conflict of the right.
Correct.
I mean, but the curves diverge. Wherever you look at it, like from the left and to the right. So why do we say that? I know that we say it, but like, why do we say there is no conflict?
Well, because both methodologies will say choose the same project. That's what we mean by conflict. So to the right of the crossover ray, if you use the IRR, let's say it'll say choose project B, then NPV will also say choose project B. But to the left, NPV will say one, IRR will say the other. Hence, we say there's a conflict between
Okay.
the two methodologies. Yeah,
All right. Thank you.
good question. Anything else? Okay, folks, see you on Saturday. Take care. Bye.